President Ma Ying-jeou, Ms. Diane Ying, Chairperson of the Commonwealth Magazine Group, distinguished guests, ladies and gentlemen, good morning. I would first like to thank the organizers of this important conference, the Commonwealth Magazine Group, for very kindly inviting me to speak at this year's Commonwealth Economic Forum. I'm indeed honored to be participating in this conference, which seeks to explore how we in Asia should adapt to the post-crisis world. Over the last 2 years, the world has experienced what is likely to have been the most severe economic and financial crisis of the modern era since the Great Depression. And what I will do in my speech this morning is first to share a few thoughts on how this great financial crisis of 2008-2009 will change the economic and financial environment in the world. I will then consider the opportunities and risks that this environment poses for countries in Asia. But to give you a preview, my belief is that the next decade, 2010 to 2019, could be indeed a golden age for Asia. But seeing this prospect becoming a reality will require Asia to adapt and innovate so that Asia can overcome some very difficult challenges. These challenges include finding the right balance between the private sector and the public management in the development and running of the financial sector, dealing with short-term economic and financial risks, particularly avoiding destabilizing asset bubbles, rebalancing domestic as against external demand in growth models, and developing broader, deeper, and more efficient financial systems. Given Asia's strengths, I see no reason why Asian countries cannot do so and become a new source of global stability and prosperity. The fundamental point is that the global economy has rebounded from 2008. And after hitting a trough in the first half of 2009, the global economy has seen consistent growth. Massive policy support provided by governments and central banks throughout the world has indeed worked. The recovery is stronger in economies that are not over-leveraged and have room for huge fiscal stimulus, including those in Asia, led by China and India, also in Brazil, and followed to a large extent by the United States and Europe. The recovery should, we believe, be sustained over this year, after which growth should settle to a long-term trend, possibly from 2011 onwards. This year, 2010, global growth could hit 3 to 4%, a sharp increase from a contraction of close to 2% in 2009. The global recovery has generally been stronger than most analysts' expectations and could further surprise us on the upside, at least for the next few quarters. Growth throughout the world, however, will be uneven, with the strongest performance coming from the emerging market economies, especially Asia. Asia will benefit from the expected pickup in global trade and manufacturing. Additionally, strong balance sheet fundamentals remain supportive of domestic demand. The economies at the center of the great financial crisis, principally the United States and Europe, should continue to grow over the coming year. In the US, growth could be moderately strong in the first half of 2010, before slowing down to a below-average pace. Although prospects for the U.S. economy have improved, it does not look that the U.S. will enjoy the growth spurt which typically follows from a deep contraction suffered in 2008. Europe, too, should benefit from the pickup in global trade, although a muted response in consumption tempers the likelihood of a strong bounce, and growth in Europe is likely to be weak. Nevertheless, despite differences in growth and other risks, which I will discuss further on, the good news is that we appear, the world, to have avoided what could have been a global depression. The global economy has stabilized. The global economy is now recovering. Beyond this recovery, the post-crisis environment will be very different from the world we have been used to, a world that has been dominated by the OECD. Our sense is that the global economic and financial environment will change in three very important ways. First, the global economy will be, to a great extent than before, extremely reliant on policymakers for the next few years. Extensive government support for the financial sector, liquidity support, asset purchases and guarantee schemes, and public recapitalization programs remain in place. These have facilitated the healing of the money and credit markets. Monetary and fiscal policies are extremely loose, and they have mitigated the collapse in domestic demand. The current recovery is being sustained by such unprecedented policies. Changes in policies or policy mistakes will thus have a significant impact on the global economic and financial environment. A key challenge for policymakers throughout the world is how to properly time the withdrawal of unprecedented monetary and fiscal policies. The economic recovery, which is still fragile, could be derailed if withdrawal is too early or too sharp. However, policymakers run the risk of creating excessive inflation over the medium term if emergency levels of policy stimulus are left unchanged for too long. In some countries, policymakers will come under pressure to repair public finances which have deteriorated because of the financial crisis. Over the past couple of months, for example, government bond yields have risen, in part because investors are growing concerned about the risk of holding such bonds. The challenge for policymakers will be to convince the markets that they have credible plans to ensure sustainable public finances over the medium to long term, while maintaining fiscal stimulus in the short term. This is particularly true of countries which already face difficult medium to longer term fiscal challenges before the crisis. US remains a risk. Other countries, including Greece, Ireland, Italy, Japan, Spain, and Britain, are vulnerable. In the emerging economies, policymakers will have to deal with rising inflation and likely asset price bubbles. In contrast to the developed countries, however, the strong recovery in emerging markets means that CPI inflation will be driven by narrowing and then positive output gaps and rising commodity prices. Asset prices, particularly real estate in Asia, have been supported by accommodative credit policies, a positive structural story, and in some countries, large capital inflows. Given likely protracted, extremely easy monetary policy settings in the developed world and managed currency regimes of some emerging markets, combined with their vulnerable underlying demand, it will be a challenging and difficult balancing act for government policymakers and treasuries to keep prices under control while not snuffing out growth or precipitating another economic downturn. Finally, high unemployment and unhappiness over bailouts could lead to populist policies, including excessive regulation and protectionism. There is, especially in the developed world, a feeling now that the financial sector has somehow rigged the system so that it cannot lose. It is simply, in some countries, too big to fail. The upcoming bonus season for banks and investment institutions, when investment professionals are expected to receive record compensation so soon after last year's turmoil in the midst of high unemployment rates in Europe and the US, will only serve to accentuate such feelings. There is little doubt that some rebalancing towards better regulation and supervision is needed. But in this environment, there is a risk that such reforms are excessive and will end up stifling innovation and growth. Protectionism also remains a risk despite the economic recovery. Indeed, despite promises by the major economies in the world, represented by the G20 in November 2008, to avoid trade restrictions, both developed and emerging countries have actually put in place a significant number of trade restrictions since then. The second major change in the post-crisis environment is the increasing importance of the emerging economies anchored by the so-called BRICS: Brazil, Russia, India, and China. As noted by Mr. Antoine van Aangard, who first coined the term emerging markets, the next decade is likely to demonstrate that we are truly living in an emerging markets century. The rise of emerging markets is not a new trend, but over the next decade, we are going to hit a tipping point where the influence of emerging markets in economic, financial, and geopolitical issues will be important, if not the dominant trend in the world. Of course, emerging markets have been growing for years now. Asian economies are well recognized as world-class producers and exporters. The Middle East and Latin America are important sources of commodities. This is expected to continue. Emerging economies are expected to account for more than half of the world's GDP growth over the next decade, and estimated by the investment bank Goldman Sachs. The combined GDP of the BRICS, BRICS, will exceed that of the US by then, and China will be 3 times larger than today, 2/3 the size of the US economy. Emerging economies are going to displace the G7 as the world's largest economies, even if their per capita incomes, because of the large populations, will still be lower. This shift in economic power to the emerging world will likely increase geopolitical risks. For one, the emerging economies, especially the BRICS, will become key global powers and increasingly demand more say on world affairs. An awkward transition is likely to occur. In terms of military power, the United States will continue to be dominant for some decades to come, and will be called upon to carry out most of the heavy lifting and spending in global trouble spots. However, the United States will still be heavily dependent on foreign countries, including some key emerging geopolitical rivals, to finance its large public debt. Conflicts could also arise over natural resources. Severe demand-supply imbalances could lead to greater and more intense competition among nations for vital resources, including energy, arable land, key commodities. This could lead to higher commodity prices, or even conflict, or both. The rise of emerging markets also puts pressure on unrestrained carbon-based growth. Aside from rising commodity prices, countries are going to face increasing environmental constraints, which will require adaptation and innovation if economic growth is not to be stifled. Our current carbon-based growth model will need to become more carbon efficient and environmentally sustainable. This is especially true as an increasingly sophisticated population add to pressures for more environmentally friendly policies. Finally, for investors, the rise of emerging markets will mean that a larger proportion of their investments will be in these markets. Far from being a risky and perhaps alternative, optional part of their portfolios, emerging markets will become a core and unavoidable asset class. At the same time, emerging markets will become a leading source of investment and credits and become large players in new and old financial markets. The third and final aspect of the post-crisis environment, which I would like to emphasize, is the longer than expected time it will take for the developed world to fully heal from this crisis. The current recovery could be strong, as I said, at least in the very short term. But even the most optimistic economists expect the bounce to be much weaker than what has occurred in the past. Beyond the recovery, the work done by the OECD, the IMF, and other economists point to weaker growth prospects for a number of years. We should therefore not expect growth in the developed world to power a strong, sustained recovery. Several reasons might explain this modest recovery in the developed markets. Notwithstanding substantial improvements, the bulk of the globalized banking system, consisting of major banks in the US and key parts of Europe, are likely to remain capital impaired and subject to greater regulation. In the US, the banking sector is being supported by massive policy intervention and will likely be stable enough to support subpar growth. However, it may not be strong enough to support the credits needed for sustained growth much above the potential growth of the US economy. This is also likely to be true for Britain and some countries in Europe, which have banking and real estate sector problems. US household consumption is unlikely to be robust, as spending is being undermined by weaker income prospects, high unemployment, weak house prices, and the need for high savings to maintain long-run consumption and to repay debt. Household leveraging is likely to take a number of years, keeping the overall recovery muted. And as if these headwinds were not enough, re-regulation, higher taxation, government intervention, and the pressing need for medium-term fiscal consolidation will also constrain growth in the developed world. Aging populations will also increasingly be a drag on growth in these economies. So the future economic environment is thus likely to be different from the past in three key aspects. First, over the next couple of years, government policies will have an inordinately large impact on the global economy and the financial markets. Second, the tipping point will be reached in the next decade, when emerging markets will become a significant, then a dominant global actor. And third, developed economies could face years of low to subpar growth. What does all this imply for Asia? I will group Asia's challenges into four areas. First, at a very broad level, are the fundamental uncertainties now raised and being questioned by many people of the apparent failure of the Anglo-Saxon model of financial sector regulation and development, as well as financial stability management. At the extreme, these paradigms seem to have to put blind faith in markets and a likely regulated private sector, including a belief that markets, especially the financial and capital markets, will regulate themselves. In the last decade, we have seen a sequence of crises, starting with the dot-com crash, the Enron scandal, LTCM's near failure, and finally the great crisis of 2008-2009. However, notwithstanding these crises, the longer-term evidence points to the great benefits that sound and mature financial sector development and liberalization can bestow, especially in enabling a successful transition from an emerging economy to a developed economy. So what should Asia learn and do to keep the potential of well-functioning markets while minimizing the risk of instability or crisis? It will take time before we will know the answers to these questions. But Asian countries have never had a blind belief that the markets work best all the time, or that the public sector is inherently always inferior to the private sector. As noted by two Chicago economists, Mr. Raghuram Rajan and Mr. Luigi Zingelis, in their book, Saving Capitalism from the Capitalists, Asian countries have long recognized that markets are, after all, human institutions, and markets can work imperfectly. Government intervention and guidance might therefore be needed to ensure that markets function well. The challenge for Asian policymakers is to chart an appropriate path between private sector leadership and appropriate public intervention and regulation in the development and management of Asian countries' financial sectors. Unfortunately, almost from first principles, learning from some of the mistakes which have happened in 2008, 2009. The second area of challenge for Asia is for policymakers to respond flexibly to risks as the global economy recovers. One medium-term challenge in many countries is how to manage rising asset prices. Across the region, we have seen significant rises in equity and real estate prices on the back of domestic reflationary policies and capital inflows supported by low global interest rates. These have not in general hit their previous peak and can be justified by positive fundamentals, but continued low interest rates could push these prices higher and eventually lead to another bubble. As in the early 1990s, managing large capital inflows and prospective bubbles will be a major task for policymakers in the next few years. Asian countries have to be very vigilant so that they do not repeat the same mistakes which led to the Asian financial crisis in 1997. While not my central expectation, Asian policymakers might also have to respond more forcefully if recovery in the US and OECD turns out to be weaker than expected and the world finds itself again threatened by another recession. The third area of challenge for Asia is a need to rebalance to a more sustainable economic growth model. This is particularly true for countries with large populations like China and India. Asia's economic growth model will need to be reoriented from depending largely on exports to a more balanced model which is also dependent on services and domestic consumption. Such rebalancing will be helpful in three ways. First, as growth in the developed world, hereto underpinned by the US consumer market, is likely to remain weak over the next few years, stronger domestic demand may help to mitigate some of this weakness. Second, insofar as some of this rebalancing will be done through increased domestic investment, it could help to improve productivity and an economy's productive capacity. A more balanced growth could also help to reduce income inequality. Third, more balanced growth will reduce pressure on the environment. As noted earlier, a growth model that is heavily dependent on resources will soon hit constraints given the amount of supply available, so innovation and adaptation are necessary. Indeed, a strategy that relies mainly on cheap factors of production, labor and other inputs, is not likely to work as well going forward, especially outside excess labor economies like China, India, Indochina, and Indonesia. Instead, the rest of Asia will need to look at its own institutions and markets to drive more sustainable and higher quality growth through strong productivity improvements. In this economic environment, the winners in the next century will be those countries that can evolve to become the world's leading innovators and designers, rather than those countries whose factory floors will be buffeted by the volatility of structural change and intensifying competition from large labor surplus economies. Innovation-driven economies require supply-side nimbleness and strengths. Investment in human capital, that is education, healthcare, and research and development, hard and soft infrastructure, including competitive domestic markets, and an environment that will attract and retain talent, as well as foster creativity and entrepreneurship. Such an environment will not be compatible with low-cost production-oriented strategies. And this brings me to the fourth and final important challenge for Asia arising from economic crisis. Asian financial institutions and markets have been given a once-in-a-lifetime opportunity. The globalized Western banking system, hampered by capital constraints and re-regulation, will likely not be able to intermediate the massive capital demand needed to finance growth in Asia. This leaves the playing field unusually open for Asian banks and other financial institutions and markets, particularly over the next few years. Fortunately, Asian banks generally came into the crisis much healthier than their global counterparts, given the experience of the Asian financial crisis in the 1990s. Capital, liquidity, and non-performing assets were at healthy levels, while exposures to toxic assets of the Asian banks were limited. Asian household, business, and government sectors are relatively unleveraged with excess debt. In order to take advantage of this opportunity, however, Asian banks and capital markets will need to develop quickly to step into the breach. In this context, regulatory and development authorities in the financial sector in Asia will need to cooperate as never before with each other and world financial institutions to develop regional financial and capital markets. To conclude, given the strong fundamentals, Asia is recovering well from the great financial crisis of 2008-2009. The post-crisis environment will be different in at least three significant aspects: greater reliance on policymakers, the dominance of emerging markets, and the relative underperformance of the developed world. And this poses four challenges for Asia. First, Asian financial development will have to find the right balance between the private and the public sectors. Second, Asia has to respond in a flexible manner to a more volatile economic environment. Third, Asia has to develop a more balanced and sustainable economic growth model. And finally, Asian financial institutions have to gear themselves to take advantage of an unparalleled opportunity to develop and mature. These are difficult challenges, but I'm optimistic Asian countries will overcome them. The next decade could thus be, as I said, a golden age for Asia. Asia's fundamentals are generally sound, policymakers have lots of flexibility, and Asia's population is hardworking, young, and educated. The road will not be smooth. There will likely be bumps along the way, even a few crises. But if Asia learns the right lessons from history, especially those of the recent great financial crisis, we can retool and reorient ourselves to propel Asia into the next stage of its development. Thank you very much.